the Calvert the Calvert County Commission for Women and the Calvert County Library. I want to welcome all of you for coming tonight and thank you for making the adjustments and joining us all virtually. Just a couple quick things to mention. If you're not familiar with the Calvert concept, we are a nonprofit that operates in Calvert County that has one basic function, and that is to turn the dream of home and business ownership into a reality for hardworking individuals who have been denied that opportunity either through social injustices or because they are frontline community workers here in Calvert County but can't afford to live here. The Calvert County Commission for Women is a commission of the Calvert County Commission for Board of Commissioners that works to improve opportunities for women and girls by promoting education and employment and serving as a voice and advocate, identifying issues that need to be addressed in Calvert County, from everything from health care, daycare, to jobs and financial improvements here in the county. And so we ask everybody to check out the Calvert County website and go to the Commission for Women if you're interested in learning more about that. Or on social media, Calvert Women Connect, where we post our education programs and upcoming programs. I forgot to mention that the Calvert concept can be found at c4housing.org if you wish to learn more about this nonprofit and how you can get involved, and also on all social media under Calvert Concept. And our third partner is the Calvert County Library. If you are tuning in, you already know how wonderful they are, but do want to remind everybody, as we have had several snow days, you can always access the Calvert Library through their website and through their Libby app. Their resources are always available. Now, really what you're here for is not to hear from me, but to hear from the amazing Susan Allen, who is going to talk to us all about all the tax changes that have happened in the last year. So Susan has over 20 years experience as a licensed CPA, which is a certified public accountant, and a business owner. In her CPA firm, she specializes in business and individual tax preparation. She prepares financial statements and tax returns for HOAs, nonprofits, commercial and residential rental properties, and many other businesses. She also serves on a variety of various boards and as directors for nonprofits, including the Maryland Farm Bureau, the Calvert County Historical Society, the Calvert County Fair Board, the Tidewater School, the Calvert County Farm Bureau, and the Southern Maryland Invitational Livestock Expo and Waters Memorial United Methodist Church. Susan, thank you so much for joining us. I know you told me before we started that you are happy to take questions throughout the program and you would like this to be interactive. I will say, when I mentioned how amazing our library is, I'm not kidding. They will be monitoring the chat. So if you have a question that comes up, if everybody would put it into the chat so that our library professionals can help make sure everything's going smoothly and that Susan gets all the questions as they're coming up. And with that, I'm going to turn it over.
Well, thank you, Catherine. I really appreciate it. I really appreciate being here. And anyway, and I thank everybody for being accommodating to switch this to virtually instead of in person at the last minute. Like I said, like Catherine said, I do like it to be interactive, and I would have liked it more in person. But this will work. We can make it work. And I love what I do. I've been doing it for a number of years, and and so I will, please ask any questions you have, and I'll do my best to try to answer them. And I'm going to kind of go quickly through the first section because when I start talking about some of the new tax laws, I want to go over just some tax terminology just to make sure everybody understands what I'm talking about as we go further along into the program. So at 1040, and you most know that is what an individual tax return is. That's where you report all your income, and if you have any deductions that you qualify for, you'll take those. Any credits, you calculate the tax, you compare it with whatever withholding, whatever money you have put in the pot through your W-2 or estimated taxes. And the tax return is just a reconciliation of what your total tax is and what you've put in the pot. And so that difference is either a refund or you have to pay the IRS. And I do a lot of tax planning with all my clients, it, and I know a lot of people say, "Hey, I want the largest refund." No, you don't. You want you want the break-even point. Otherwise, you're just letting the IRS use your money all year long, interest free. And so that's why I try to do some really good tax planning with clients to try to get it as close to break even as possible, or even just owe just a little bit. And that way they didn't borrow your money at all during the year. Um, so that's what a 1040 is. The income on a tax return is probably for most of you, it's your W-2. It's where you work. Um, you could have self-employment income, so that's income. You could have rental income. You could own a piece of a business and you get a K1. Your interest, your dividends. There's a gambling winnings. There's a lot of things considered income, and whether you and I tell all my clients is whether you get that 1099 or not, you're required by law to report all income received. Um, and then the next thing is the deductions. Your deductions are, um, they could be, and it just depends what you're qualified for. If you're a teacher, there's an educator deduction of $300. There's if you contribute to an HSA, there's an HSA deduction. There's an IRA, if you contribute to an IRA, there's an IRA deduction. There's a student loan deduction. And then we'll go into some of the brand new deductions in just a little bit that got passed for 2025. And then you have your itemized deductions or standard deduction as the next thing on the tax return. And itemized deductions are it's Schedule A, and what that is that's where your medical expenses go. That's where all your real estate taxes or your income taxes paid to another state go, your mortgage interest, and your charity. So those are the things that would be itemizing deductions. And so what we look at is, are your itemized deductions higher than the standard deduction? And the standard deduction is actually pretty high now, and we'll look at that in just a little bit too. Then part of the tax calculation, you may qualify for some credits. And some of the credits are, the most common ones are the earned income tax credit, the child tax credit, the dependent care credit, and the education credit. And so that's more of just the tax terminology. And we'll scroll down to the next page. And so I wanted to show you what the 2025 tax brackets are. Can we change it to the next page on the PowerPoint presentation? Thank you. So when I was talking about you're taking your W-2 income or all your income sources, less your deductions, is when you have to calculate what the tax is on your total income and minus that standard deduction as well. And so this is what we look, and then so that when you get to that line item, that's called taxable income. And so then we take that taxable income and we look at this chart, and these are the, when you hear, hey, I'm in the 12% tax bracket, that's what that means. Let's say if you're married filing jointly, if your taxable income is under $96,950, you are in the 12% tax bracket. And so you can see all the various, if you're head of household, married filing separately, married filing jointly, or single, what the tax brackets are. And it does not mean, a lot of people get confused that, oh, so once I hit that $48,000 and I'm single, I got to pay 22% taxes on all my income. No, you don't. It's a graduated system, so you're going to pay 10% on that first $11,925. then you're going to pay 12% on 11,925 to 48,475. So if you're right at, let's say, $50,000 taxable income, you're only going to pay about $1,500 in the 22% tax bracket. So it's not horrible that you've jumped up from 12 to 22 because you could have just crossed over that line. I'm going to ask if there's any questions that where we are now.
Val asks, are the slides going to be available after the webinar? I think that you will allow us to send them out.
I think you have it, so you can.
Yeah.
You're free to post it.
Great, thanks.
Yes, Val, I'll be sure to email those to you afterwards. We email them to everyone that registered.
Fantastic. Thank you. Any other questions, or was that it?
That's everything in the chat.
Okay. All right. The next slide, please. So, and I don't know how many in the group prepare their own tax returns, and your returns might be simple enough that you're preparing your own returns. And so, anyway, there are a lot of common tax return mistakes that can happen, and I'm just going to go through them quickly. And I do want to stress that with all these new tax laws, it probably is important to make sure that you don't qualify for some, you might qualify for something, and if you prepared it on your own, you may not be aware of all these new tax laws that you're qualified for. And the biggest thing is, and I'm only going to talk about the federal side of things, but we all live in the state of Maryland, and Maryland is constantly doing a lot of tax law changes as well. And there are a lot of missed deductions for folks because they didn't know this existed. But I won't go through all of that. We'd be here all night. But anyway, we're just going to go through this list of common tax, and some of them are simple: math errors, incorrect filing status, and the biggest one I see is single versus head of household. And you really have to know that law, whether you really qualify for head of household or you're single. And head of household is if you had mainly you're caring for your child, you are not married. That's the most important thing. You are not married, and you have a child that you're caring for, lives under your roof, and lives with you 6 months or more out of the year. And then there's certain rules that if there is a alternating, ex-spouse or that you have to have, them sign off on a form that says you're qualified to take this child as a dependent. Another big mistake is failing to report all income. Not knowing the tax deadlines. More typos, just wrong social security number, and that it is very important to double check your social security. Even in this office, we're probably checking that social security number on a new client probably 10 times because we do not want that error or filing a tax return under somebody else's social security number. Of course, we're all human and mistakes happen. Incorrect bank information. That one is the one we see a lot. A client, if they give us the wrong banking information because they thought they knew it off the top of their head, and they wonder why they're not getting their refund. Well, it bounced, and then it takes the IRS probably 6 to 9 months before they can release a check to you. That's one thing I do want to bring up. I do not have in the slides anywhere is the IRS will not be issuing checks, and they said through September 30th, but they may have extended it a little bit longer now. But they want to get out of issuing checks. They want everybody to use direct deposit, and they also want you not mailing checks to them. And they want this isn't mandatory yet, but it will be phased in probably over the next couple of years. you will not be able to mail a check to the IRS anymore. They want you to pay some sort of electronic way, whether it's through the software or through their website, which is irs.gov/payments. And that's and so anyway, that's a new thing that's coming up this year. Another common mistake is just you forgot to sign the return, and it'll get rejected, and the IRS will not process that return without a signature. I've seen this before with the new client. They'll tell me they got 3 kids, and I'll only see 2 of them on there, and they forgot to add the baby on the return. Of course, if you're mailing in a return, which that probably isn't happening too much anymore because everybody's probably doing things more electronically now, and it's really safer to send returns in electronically because there's so much mail fraud going on right now. Your social security number is on that tax return that you're sticking in that mailbox. And anyway, I would much prefer to send it securely through an electronic channel to that tax return. And also, I know the IRS has that tax return the way I prepared it, and not some data entry clerk retyping the information in, and then another mistake could happen. Making sure your address is correct. The big thing, and we mentioned this earlier, is missed deductions or credits, or even on all these new tax laws, missed the things you qualify for, and you didn't, you're not getting the lowest, because the goal is to get the lowest possible taxable income, so you're paying less taxes.
Susan, there is a question sort of related to that. They ask
Yeah.
about whether TurboTax will be updated sufficiently to cover, like TurboTax and TaxCut and those sort of softwares will be updated to cover any of the new deductions, etc.
I would imagine they would be. I've never used any of those softwares. So I mean, they're selling it, so I would imagine they're going to cover it. But the thing is still with when you prepare your own return, and those types of software are question answer sort of things. So if you answer the question incorrectly because you didn't understand the tax law, then you're not going to get the appropriate deduction because you didn't you answered the question incorrectly. So I'm always cautious for people. If you have a little bit more of a complex return, I'm cautious of people attempting to try to file those on your own. Any other questions on common tax return mistakes? If not, we will move on to the 2025 new tax law changes. So the child tax credit, and I'm just going to kind of give you some history. For many, many years, the child tax credit was only $1,000. Then all of a sudden during COVID, it had jumped up one year to like 3,600 or something crazy, and then it dropped down to 2,000, and then now this year it's jumped back up to it's even jumped up further to 2,200, and so that is huge. If you had 3 kids, there's $6,600 as a credit, and a credit is that's dollars after creating that tax. That is money in your pocket, and the refundable piece of that 2,200 is $1,700. So even if your tax liability came down to 0, you could still get $1,700 as a refund, even though you didn't put any money in the pot. You'll still get $1,700. So that's pretty cool. And there's a new senior deduction for those 65 and older. And I'm going to back up a little bit. So the standard deduction, and we talked about standard deduction versus itemized deduction. And most people are taking the standard deduction right now because it is so high. So for single, the standard deduction is $15,750. Married filing jointly, it's $31,500. And head of household, it's $23,625. And these are the 2025 figures. So if you are a senior, 65 and older, and let's say you're married, and both of you are 65 and older, there's $12,000 that gets added to your standard deduction of 31,500. So instantaneously, you get a deduction of 43,500 off of your income. So if you have retirement income, let's say you have retirement income, some interest in dividends, and your Social Security, and all of that only equals like $50,000. Then once we subtract that 43,000, you're only paying $6,500. You only have taxable income of $6,500, and if we go back to that other page where that 6,500 is, that's in the lowest tax bracket of only 10%. And so you'd only owe $650 in tax. And even though your income is $50,000. So that's pretty cool that for the seniors, it's a huge deduction of $12,000. However, if your income is a little bit on the higher side, it does phase out. If you're single, it phases out at 75,000, and married filing jointly, it does phase out double that, 150,000. And so you don't get that $6,000 deduction if your income is higher than that. So when you are itemizing deductions, remember I mentioned medical, and then the second item on Schedule A is your state and local taxes, real estate taxes. That since 2017 has been capped at only $10,000. And in Maryland, it is very easy to get over that $10,000 and you're having a loss deduction. A lot of our real estate taxes are $4,000. If you're married and you're both working jobs, you're paying Maryland income taxes of, let's say, $4,000 each. There's $8,000. Right? Before there's $12,000. So then when we were capped at that $10,000, you immediately lost that $2,000 deduction. Well, now they passed a law that it is capped out at $40,000. So now most of Maryland, well, quite a few Marylanders, they're not going to get to that $40,000. And that is only for 2025 through 2029. That's all it was passed for. So it very well could be in year 2030, it could drop back down to that $10,000 cap unless Congress extends it.
There are a couple questions about the senior deductions.
Yeah.
So one was, is there any senior deduction if you make over 75,000, or is it an all or nothing?
There is a small phase out. But it starts phasing out at 75,000. I forget the upper end of that. But it starts phasing out at 75.
And that's not year bound. One of our visitors said that they thought that everyone 65 and over got the 6,000 in 2025, and then it phases out after that. No?
It is good for 2025 through 2028. That's all it was passed for.
But it does matter your income.
Oh, yes. And I can look that up right now. The upper end of it. Oh, it's actually a pretty high. Single, the full elimination is 175,000, and for joint, 250,000. So it's a slow phase out.
So you'd get some portion of the 6,000 off if you're
Exactly.
under that amount you just said. Okay.
Yep. I don't have all of it memorized yet, all the new stuff. But the next item is the qualified tips deduction, and this one and the overtime are probably what you're hearing in the news all the time, and I must have gotten hundreds of questions on these two areas because the news it does not always portray what the actual law is. So the qualified tips deduction is only up to 25,000. It also has phase outs if your income's greater, if you're single, greater than 150,000, or 300,000 if you're married. And the tips, you have to, so there is a lot of underground cash and stuff going around in our, all across the country. And so a lot of in the hospitality industry, they're not reporting all their cash tips. So if you're not reporting them, you can't take the deduction. You have to actually pay the taxes up on your W-2 with those tips before you can get the deduction. And so on your W-2, there actually is a line item that says qualified tips. And that's been there for many years. And so that's how we're going to be able to know if they receive tips from their employer through their wages. And and I'm not going to name all of the industries, because I want to say it's like 43 different industries that you have to be in a certain industry before you're allowed that tip deduction. And it's your obvious ones, your hairdressers, your restaurants, my biggest mother, cab drivers. It's your obvious type tips. And anyway, so that's the tips. Are there any questions on the tips?
Well, I actually have a couple going backwards. There was one to get clarification about if there are two, if you're filing jointly, if only one of us is over 65 and the other person is not, how does that affect it?
Yeah, we get one $6,000 senior deduction.
Okay. And then the other question is about the state and local tax deduction, which the question is, does that mean I can deduct my state and local taxes?
You can if you itemize deductions, but if your standard deduction, let's say you're married, is 31,500, but your itemized deductions, because you don't have much mortgage interest or your charity's not that high, only equals $20,000. Of course, we're going to take the deduction that is higher. We're going to take the standard deduction, which is 31,500 versus 20,000. We're going to do what's best for you. So it might come into play that state and local tax deduction doesn't mean a thing, because the standard deduction is better.
And then a clarification about, it says if you itemize and don't take the standard, let's see, a senior deduction, how much can you still take the senior deduction whether you itemize or not, maybe is the question?
Yes, yeah, it actually shows up on the tax return in two separate spots. The senior deduction actually is in the same spot as where all other deductions go, like your educator credit, your educator deduction, your IRA. It goes in on page 1 of the 1040. The itemized deduction is in a different spot on the tax return.
Okay,
It's not in the same bucket.
two separate things. And then a follow-up question, not quite related, but it's about a deduction. Is there a cap on mortgage interest?
Not really. There is if your home is $750,000 or more, the acquisition price, then there is a proration for that interest. But I don't see that often.
I'm not sure. There's a question that says, is the $6,000, I guess the senior deduction, what's given for Social Security not being taxed? I'm not sure I understand the question.
It has nothing to do with Social Security. So your Social Security is taxed at it, depending on your income. Most people, it's a small amount of income. I would say it's over like 32,000. Your Social Security is taxed at 85%, and that's what is the taxable piece of it. But the senior deduction is another. It's a deduction of, so it would offset your Social Security to bring your taxable income to a lower number.
And then there's a follow-up question on auto loan interest and whether that deduction can be for a vehicle you purchased in 2022.
And I'll get there. I haven't gotten down that far yet, but I'll explain that in detail.
Those are all the questions in the chat.
Okay, overtime was the next item. So this one is, and this is the one where there was a lot of confusion on. So your overtime is typically, and I'm just going to use the typical, is 1.5 or time and a half of your regular pay. So if you made just $20 an hour, then your overtime pay would be $30 an hour. And so those $30 times, let's say you worked 1 hour, is $30. So the overtime, the deduction is only the premium amount of that overtime. So not the $20 an hour, but the $10 an hour. So you would only get a deduction for that premium, so that $10, if it was 1 hour of overtime. And so that's the example I was going to give. But the maximum overtime deduction is $12,500. This has the same phase outs as the tips deduction. If you're single, it phases out at $150,000. Married filing jointly phases out at $300,000. Any questions on the overtime? And oh, the other thing is, if you're in a job where you get double time, you still you would think you would get the double piece of it as the premium amount, but no, the IRS said you only get that 1/4 of your double time as the deduction. So it's quite confusing. And so what this one is an area that the IRS said, hey, we don't have time. We're not adjusting the W-2s this year. So we're going to put the burden on your employer to provide the employee with the appropriate letter or some sort of notice what your overtime pay was, what the premium amount was. So what we are asking for, and I've already done quite a few tax returns just this week, and what we're at, and I've already seen quite a few of the overtime. What we're asking for is your last pay stub in December. If you had 2 jobs throughout the year that you got overtime, I want that last pay stub in June, whenever you quit that job. And of course, if that employer provided that letter that they're supposed to provide, but I'm also seeing that they're not providing that letter. Any questions on overtime?
I don't see any overtime questions, but there is a back question related to that senior deduction. It says there were a lot of things were said prior to the signing of the bill about no tax on Social Security. Is that something that didn't pass?
Oh boy, did I get a ton of those questions? No, that was all rumors through the media. That was never even a discuss. I mean, well, I should say it was a discussion, but it never came to fruition at all. The Social Security is still taxed just like it has always been.
And now there is a question about overtime. So you can use your last pay stubs along with your W-2 to figure out your overtime deduction?
Yeah, the W-2 is going to be useless until 2026, and then employers are going to be required to report it on your W-2, that premium overtime. But right now, we're asking for last pay stub, or the employer actually is supposed to give you a letter stating, hey, here's the premium amount on your overtime. But all this is new, and all the employers, they didn't stay up with the law, or maybe they're doing the payroll themselves. They don't have an accountant. Who knows what the case may be. But in my humble opinion, these 2 areas, whether it's overtime or the tips, since the IRS refused to adjust the W-2s, and I should specifically say overtime in particular, I don't see how in the world they could audit this area without putting the guidance on that W-2. That's my opinion, but okay, the auto loan interest deduction. It is up to a 10, so it is only the interest that is deductible, and it is only on a brand new car that was purchased in 2025. And the interest deduction is $10,000. And I'm going to give an example on this. Even if you bought that car in January of 2025, to get that $10,000 deduction, and if you bought a $50,000 vehicle, bought that car in January, you would be paying, to get that $10,000 deduction, you would have to have an interest rate of 20%. This piece of the tax law to me is useless because most auto loan interest are pretty low. So even if you bought a $50,000 vehicle at, let's say, a 5% loan, it's only a $2,500 deduction. It is not much of a deduction, and it has to be a brand new car. And so I'm going to see very few of this for a deduction. I have no clue why it's even made it in the law.
So, Ms. Green, hopefully that answers your question about the car purchased in 2022. We cannot.
Correct. And a couple credits are ending this year, and there used to be a $7,500 electric vehicle credit that ended September 30th of 2025, and then all the energy efficient home improvement credits also, and oh, I got a typo in here, and it ended 12/31/25. And the energy efficient home improvement credits are and they were minimal credits, but anyway, new doors, windows, heat pump, AC, water heater, insulation, pellet stove, and then some of the larger credits were your solar panels and geothermal systems, that sort of thing. And they were like a 30% credit, but they are gone now.
And then there's a clarification again on that Social Security piece, but I think you've said it, that Social Security continues to be taxed the way it has been. The OBBBA did not change that.
Correct. Now, if your income, and don't quote me on this, if your income is below all your other income on your tax return, and this law has existed for forever, all your other income on your tax return less than 25,000, then the Social Security is not taxed. But that's nothing new. That's nothing new. And then there's if it's 25,000 to like 32,000, it's taxed anyway. It's kind of prorated, but like 50%. But then after 32,000, then it's taxed at the 85%. Okay. So I was going to move to the 2020, the next slide, the 2026 tax law changes. So that's now, and there's a few kind of big changes. The dependent care credit, which used to be $600 per child for up to 2 children, it's jumping up all the way to $1,500 for the first child and $3,000 for 2 or more children. So that's a huge credit for those that send their children to daycare. And I don't know how many people remember, I want to say it was 2018, 19. It was only for a 2-year period where you had what's called an above the line deduction for your charity. So, because most people, since, as we mentioned, are not itemizing deductions, so they're contributing to their church or fire department or whatever it may be. but they were not getting a deduction for it. So back in 2018 or 19, there was a piddly little $300 what they call above the line deduction. Well, now they've expanded that, and that disappeared. That only was a 2-year period. Now it has come back, and you can get, if you're single, you can get an above the line deduction for charity of up to $1,000 and $2,000 for joint. So that's huge. And it is cash gifts, not your non-cash, not taking your clothes to Goodwill, that sort of thing. It has to be your documented cash gifts to the church, fire department, etc.
And I'll just clarify, cash could also be a check.
And well, the IRS uses the term cash because that's what they mean by a check, but I prefer checks. If you give cash at the church, you're not going to get a receipt, you're not going to get documentation, and you're not going to get a deduction. So it really should be, whether it's put on your credit card or put on a check written so that you have documentation. And because you typically, I like to use the church because the church at year end will give you the statement saying, thank you for your contributions here. And they usually give you like a nice little list or give you a total of what your total contributions were throughout the year. But that's only if you write the check, not the cash.
Or you use the magic envelopes.
Or use the envelopes. And I actually, at my church, I'm the one that said that because I said, hey, if these folks want the deduction for the cash, grab the envelope, put your cash in that envelope, and write your name on the outside of it. At least that way you get the credit for it. Okay, the next item for 2026, and this is kind of huge because this is what we're working on right now, is the threshold for your subcontractors, or it has always been $600. If you made under $599 or under $600, you didn't get a 1099. But if you made more than 600, you got a 1099. Well, now that filing threshold is $2,000. So we do not have to issue a 1099 for all these small amounts now, which is it's time consuming on our part.
These are for like the gig economy, like Uber drivers and that sort of thing.
Mm-hmm. Exactly. But you're still required, whether you make $600 or $1,000, you're still required to report all your income, even if you do not receive that 1099.
So you have to track it yourself.
You did one DoorDash for $100. I would call that de minimis and not reportable.
There was a question back on the charitable cash gifts, just to verify this $1,000 or $2,000 for joint is above the standard deduction. You get to take the standard deduction and also this, right?
Exactly. Yep. And the teacher deduction increased from $300 to now $350. They are so unreimbursed employee expenses disappeared in 2017, except for teachers. Teachers have always gotten a small above the line deduction. It was $250 for many years. Then it jumped up to $300 a couple years ago, and now it's $350. But that's the only industry that gets a deduction for unreimbursed employee deductions. There is a new thing, and I don't know a lot about it yet, only because it doesn't exist yet, is this new Trump savings account, and it doesn't begin until 7/4/26. There's a website, you can sign up for it. You can, and it's only, and it, I want to say it works similar to like a Roth IRA. You can fund the account for children that are under 18, and you can only fund it up to $5,000. And the only reason I'm not 100% fan of it is because they haven't told you how it will be funded. If you went to your Edward Jones, your Merrill Lynch, whoever your financial advisor is, and you opened up, whether it's a 529 plan or a Roth IRA for your child. Now, you have to have earned income to open a Roth IRA, but if if you were to open up some sort of savings account for your child, you would have control with your financial advisor to say, hey, I'd like the investments to be in this ETF or these stocks, or you would have, you would at least know where it's going. Now, it's the unknown of how this is going to be invested and what kind of growth it would have on it. However, if you have, this is the only where I would say that it could be beneficial once you find out what type of growth it could possibly have. Now, I know any investment there's risk, but if you have a new child born between 25 and 2028, the government actually will give seed money of $1,000 and put it into that account. So if you funded your child that's 10 years old and you funded it for $5,000, it would have $6,000 in it immediately. No, not till after July 4th, but so that's about all I know on that. I think
Well,
we'll know more as after July gets here.
so I maybe misheard you, but so you said a 9-year-old, if you funded your 9-year-old at $5,000, you still get this thousand? I thought it was only for babies, basically.
Oh, I'm sorry. I'm sorry. Forget that. That's a bad example. Yeah. So it would have to be at the newborn child is 0 years old, born in 25 to 28. You'd get that $3,000. Yeah. I'm sorry. That's the only right now until I learn more about this. That's the only thing I would recommend is because you get the $3,000, and I think that's who it's incentivized for.
So it's $1,000 a year in
No,
25, 26? No?
no, no, you get a one free $1,000 initially when that child's born.
Okay.
But here's the thing: we're supposed to be able to put it on the tax return, but I've looked at our software and it doesn't exist yet, and I think it's because we can't do it until July 4th. We can't, if a parent came to me and said, "Hey, I have a newborn, I'd like to fund this new savings account," I don't have a way to do it. If they do, I'm going to guide them to the website to fund it so that that free seed money can go into that account.
So if you don't get the seed money and you have, say, a 9-year-old, if you fund your child to 5,000, do you get a tax deduction or credit or something?
No deduction. No, there's no deductions whatsoever for it. It's just a savings account like you would open up. That's why I said I don't understand the difference between after a newborn to 18, what the benefit is, because you could go to your bank, you could go to your financial advisor, you could open up the savings account anywhere else other than the non-taxability of it. And I think that's why they're saying it works similar to, like, I should probably compare it to more like a 529 plan, like an education plan, where that money can grow and grow and grow. You fund it for $5,000, let's say when they're 2 years old, and by 18, that 5,000 is now $20,000. And for a 529 plan, that whole 20,000 is non-taxable, and you can use it for education purposes. This, I think, has the same type of theory that it can grow and grow and grow. It's not taxable, but at the age of 18, when that child withdraws it, I'm not sure what if there's any stipulation of what it has to be used for.
Okay, and back to the charitable gift question. Can individuals still deduct non-charitable cash gifts? It says Goodwill, Smile, Hospice. I think maybe she means non-cash
The
charitable
non-cash
gifts.
donation, yeah, it's still deductible if you itemize deductions. You just have to have it documented. Um, it just won't. It's not an above the line deduction. It won't be this $1,000 or $2,000.
Okay, I think we're caught up on questions.
Okay. All right, next slide, please. Okay, the one, I think it was one before that. One before, yeah. Okay, so we had some questions come through email, and there was one that I thought this would be useful, and the reason I put it in the slide is there are too many items to mention, and if it's okay, do you want me to go through the questions you sent me via email now?
Sure.
Okay. So I'm going to skip down to this one. So someone asked what type of record keeping, and so these are okay. I don't. These are what's called ABLE accounts. An ABLE account is a very similar to what we've been just talking about, whether it's this Trump savings account, a Roth IRA, or a 529 plan. It's an account but it's money that can only be used for a disabled child, adult, whatever. And so we had some questions come through about these ABLE accounts. And so one of them was, what type of record keeping does the IRS expect? And mainly the record keeping is you're supposed to save all your receipts, keep a simple spreadsheet explaining how each purpose relates to the disability, especially for like larger or less obvious type expenses. And the other question was, documentation must demonstrate how expenses relate to maintaining health, independence, or quality of life. But what does that mean practically? So that's why I included this slide to show you all the different things that the ABLE funds can be used for. These are all the different types of disability expenses. And I'm not going to read through them, but I think it's a lot more than what was mentioned in her email, the health, independence, quality of life. This actually goes into more specifics of what it can be used for. Okay. All right, now I'm gonna hop around. If are there any other questions on the ABLE account or the qualified disability expenses?
Nothing in the chat.
Okay. All right. So another person asked if the grandparent of your disabled adult child started a 529 plan, which is the education savings plan, in another state before it was understood that your child would would likely not be going to college, is it best to roll that into an ABLE account? And does it count towards the maximum annual contribution to an ABLE account? And yes, you can roll over a 529 college savings plan into an ABLE account and for that same beneficiary or another eligible family member. And there would be no taxes, no penalty. And the rollover amount does count towards the annual ABLE contribution limit, which is $20,000. And you do have to follow anyway. Just talk to whoever you're opening that ABLE account in, because you do have to follow certain rules. And if you do a direct transfer, the 60-day rule is not going to come into play. And that's what I would suggest doing a direct transfer, so there's no potential tax consequence. Okay, if your disabled adult child lives in your home and pays some rent, do you claim that as income? And if so, how, since you're not sending yourself a 1099? So yes, I have a couple clients that have disabled children, and they live in a separate, I guess what they call like the mother-in-law apartment or the garage apartment or something. And so they have, with this ABLE account, they take rent and they pay. the parents the income, and that helps pay the electric bill, et cetera, the Comcast bill, whatever it may be. And but back to what I've said before, you don't have to receive a 1099. You're going to report your rental income received, and you're going to subtract all your expenses that are directly related to that garage apartment or separate um, mother-in-law apartment sort of thing. Um, okay, if you have a supplemental needs trust for your disabled adult child, is it better to not fund it at all until your death so you don't have to file a tax return for it? How complicated will that be for the estate to handle, setting up taxpayer ID after we die and whatever else happens? So yes, so I deal with the special needs trust quite frequently, and I do recommend not that, and it should be in the will. Do not fund that until after your death. It is in your will that a special needs trust will be set up. This is how that special needs will be funded, and whoever you have designated in your will or trust, they will they will set up they will get that taxpayer ID. They will fund that account, and attorneys will help out with that as well. Okay.
So there's
Okay.
a question in the chat that
Yeah.
says, can a great grandma have a 529 plan for her great grandchildren, and could it be a tax deduction?
So here's how the 529 plans work. Yes, there is a Maryland deduction, but it is pathetic. It's only if up to your $2,500 contribution, and you would get if you and you have to open a Maryland 529 plan to get the Maryland deduction. If you go through your financial advisor and they use the Virginia 529 plan, there is no tax deduction. And it's not a federal deduction. It is only a $2,500 deduction on the Maryland return. So if you take the tax of that 2,500 times Maryland, about 8%, it's only a $200 tax savings in your pocket. And so the Maryland 529 plan, and you just have to look at the investments. So the investments they use for the Maryland 29 plan are very specific and limited. And so and this was years ago when my son was little, I had my financial advisor, he used the Virginia 529 plan. And because Maryland has a monopoly on the 529 plan, no financial advisor it can sell that 529 plan. You have to go through, and I believe it's T. Rowe Price still, to buy that Maryland 529 plan. So anyway, my financial part said that $200 tax savings. He says I can make the Virginia 529 plan. I can make those investments grow a lot more than that $200 tax savings that you would have gotten if you had bought it through the Maryland. And I believe that because like using Virginia as an example, the investments were a lot broader. I want to say they used a lot of the Vanguard type of funds, and anyway, so it did do very well. Any other questions on that? Okay. I had somebody ask a rental question. Do you really have to keep all the receipts for expenses? And they become invisible. The receipts become invisible when they're in the car, and some of mine are not legible. I do have details in my financial software. And this goes for whether it's a business, rental, any sort of deduction that you are taking on your tax return, you must have documentation. And so, yes, keeping copies of those receipts is important. So it is so, but now with the way technology has evolved, like even us, I scan all of my receipts, and that way I have them saved and you on the computer. And credit your if you use the credit card, your credit card statements will also kind of be documentation. Now you should take your credit card statement, and if it says Amazon, you probably want to print that Amazon receipt proving that it is a rental deduction, if it's very generic like that. But you really should keep all your receipts just in case you were audited.
So
Um,
speaking of receipt scanning, there's a question about, is there an app you recommend for receipt scanning for tax purposes?
I think there are some phone apps, and I don't know them off the top of my head, but I have heard a lot of clients talk about using their. And I guess it depends whether you have an iPhone or Android, the different types of. Um, but I'm not a big fan of scanning it all and leaving it on your phone. You really need to get it to your computer, and then possibly even taking a flash drive once a year and backing up your um, your files, your receipt files on a flash drive once a year and labeling them so that you have a backup copy in case your computer goes down.
Maybe that's a good thing for, is
Um,
there anybody in the session that has an app they recommend that they like? Feel free to put it in the chat.
yeah. So here, I don't know how many people have rental property, but this one is a good question. How much detail should you keep for a rental home you use personally, but for some of the personal use by other family overlaps with our maintenance and upkeep visit? Do we need to keep timesheets for those days for what we do? Absolutely. Um, so there's a rule, and these are called vacation homes. That if you're using it I have quite a few clients with beach homes or whatever, and if you so you have to if you want it as a rental property and not as a personal home where the all your deductions would be limited, um, you can't use that vacation home more than 14 days. And you have to have that documented. However, you can use that. What doesn't count toward that 14 days is if you went over to that vacation home and you're painting, you're doing work there. And because that's the upkeep, what he's mentioning as the upkeep visits. And then you would get all of your deductions. There's also what's called a material participation. And so to get the material participation so that you can take advantage of the losses, you have to document your hours, and you need more greater than 500 hours per year. And sometimes that's a little bit difficult because if you have a full-time job, it's difficult to put 500 hours in. But if you have a property manager, that 500 hours is totally impossible because you've hired somebody else to manage that property. But if you're managing it, you're the one doing the leases, the renting, you're collecting the money, you're going over visiting it, and changing the light bulb, whatever it may be, then you very well could have that material participation. All right. Any other questions?
I think we're running out of time. So yes,
Oh,
last questions. Not seeing anything else in the chat, but now's the time if you've been holding your question.
yeah.
For SE worker, do you have to file personal taxes as well? I'm not sure what SE stands for, but maybe you know.
That's self-employment. Um, Repeat the question.
For a self-employed worker, do you have to file personal taxes as well as your business taxes?
So when I said Schedule A, there's different forms that all get attached to your 1040. there's what's called a Schedule C, and that's where your self-employment income and expenses would get reported for your business, and it is a part of your 1040, your tax return. It's a part of your personal tax return. It's all one big package. Now, however, unless you create an LLC, you request permission from the IRS to be an S corporation, then you are filing a separate business tax return. But if you're just a sole proprietor, it's just going to go right on your personal tax return. And that could be a whole nother day's topic, going into the whole self-employed and tax, what you can write off, and depreciation, and that could be a whole nother topic one day.
We have a question to clarify about the 500 hours material participation. Is that maximum or minimum? I think
To qualify for the material participation, you have to have greater than 500 hours of the IRS words at regular, continuous, and substantial basis of the operation, being involved in it.
And then we have a question about SSI. So my disabled teenage son started receiving SSI in May of 2025. He's never filed before. Will he need to for 2025 now?
Yep. So if he has no other income, or even if it's minimal, and I want to say it was that 25,000 number, but if that's his only thing on his tax return is a Social Security, that is one of the examples that there's no filing requirement, and so there's no tax on that Social Security. And if he has a small W-2 job and there was withholding, you still want to file the tax return, but that Social Security will not be taxed. You'll still report it. It just won't show up as anything being taxed on it.
All right, I think we are out of time. Susan, thank you so much for joining us and switching this on the fly to be completely virtual. We really appreciate it. And the library team for managing everything virtually at the last minute. Thank you all so much for everything that you've done. The slides are being sent out to everybody who registered in advance for tonight's topic. As you guys saw, it was recorded. This will also be available on the Calvert Library's YouTube page for generally 90 days. Library can correct me if I'm wrong, but to highlight it for that. So Susan, thank you very much again. Next month's financial literacy series, last Wednesday of the month, is going to be basically credit scores 201, anything and everything you wanted to know about your credit score and how to get it higher. Thank you all.
Thank you.
Lots of thank yous in the chat, Susan. So thank you very much. Very helpful. Thanks, everybody.